Markets are on fire with fear and speculation. In Japan, the Prime Minister's sudden resignation has thrown Asia's largest economy into chaos. In France, political turmoil threatens Europe's financial stability. In the United States, weak jobs data and growing political interference at the Federal Reserve are shaking global trust. And while chaos reigns, gold is exploding to record highs, with analysts daring to whisper a target of $5,000 per ounce. This isn't business as usual. It's the kind of moment when history accelerates, when financial systems get stress-tested, and when the cracks in the world order suddenly become impossible to ignore. Japan implodes, a shock resignation? Japan is no stranger to political churn, but this was different. Prime Minister Ishiba's sudden resignation caught markets by surprise. Political instability in the world's third-largest economy can have immediate financial consequences. The yen weakened sharply as traders sought safe havens elsewhere. Japanese equities slumped, especially banks and exporters. Bond yields spiked, raising borrowing costs for a country already burdened with debt over 260% of GDP. This isn't just about one resignation, it's about trust. Investors had assumed stability in Tokyo. Instead, they now see fragility. We'll dive into parallels. In 1998, when financial minister resignations fueled panic during the Asian financial crisis. In 2010, when Europe's debt crisis revealed how political instability can morph into financial contagion. Japan's crisis is another reminder that politics can shatter market confidence in hours. France on the brink? Across the globe in Paris, another drama is playing out. Prime Minister Bayrou faces a no-confidence vote as debt worries spiral. France isn't a minor player. It's the second-largest economy in the EU, and any instability there threatens the entire Eurozone. Markets already jittery about Italy and Greece now see France in trouble. Bond spreads widen. Investors fear another Eurozone debt scare, like the crises of 2011-2012. This section dissects how fragile fiscal positions in Europe amplify political risks. Why markets fear a Frexit-light moment, where French politics undermine confidence in the euro. What it means for German, Dutch, and peripheral markets that are tied into France's economic fate. The story here isn't just about France, it's about the entire European project wobbling under debt, politics, and public discontent. The Fed at a crossroads. Meanwhile, across the Atlantic, the Federal Reserve is under siege. The U.S. economy grew at 3.3% GDP, but job growth collapsed to just 22,000 in August. Unemployment is rising, and markets are now betting on a 50 basis point rate cut at the September 16-17 meeting. But the real drama is political interference. Treasury Secretary calls for oversight of the Fed are sparking fears that independence is dead. Investors worry that Powell will be pressured into cutting too fast, risking credibility. History teaches us that once central banks lose independence, trust erodes. Look at Turkey in the 2010s or Argentina in the 2000s. Now imagine that happening in the United States. This act explores why weak jobs plus political pressure create a toxic mix. How rate cuts could spark short-term rallies but long-term instability. Why the Fed's September decision could define the decade. Gold explodes. While bonds and currencies wobble, gold is roaring. Prices smashed through $3,600 per ounce, and analysts are eyeing $5,000. Silver is climbing too, boosted by both safe haven demand and industrial uses in EVs and solar. Why gold? It's the only asset with no counterparty risk. It shines brightest when trust in governments, central banks, and currencies evaporates. Central banks are buying more than ever, diversifying out of the dollar. We'll compare this gold rush to 1980, when inflation fears sent gold skyrocketing. 2011, when post-Lehman debt fears drove record prices. 2020, when the pandemic ignited safe haven flows. This isn't a small spike. It's the early signs of a new gold era, where investors look for safety in tangible stores of value. Global crosscurrents. The drama in Japan, France, and the Fed doesn't stay local. It spills across markets. European stocks sink under political pressure. U.S. equities wobble as bond yields slide and tech giants face spending pressures. Emerging markets tied to dollar debt watch nervously as capital flows swing. China's 10-year yield at 1.8% signals deflation is being fought successfully, hinting at a possible shift in global equity leadership. We're witnessing a tug-of-war, fear on one side, opportunity on the other. This act zooms out to show how one crisis triggers another, creating ripple effects that no investor can ignore. Lessons from history. History doesn't repeat, but it rhymes. In 1994, bond yields surged and wrecked portfolios. In 2008, political missteps turned a housing bubble into a global crisis. In 2013, Bernanke's taper tantrum exposed emerging market fragility. In 2020, COVID showed how fast trust can vanish. Today, Japan's resignation, France's turmoil, and Fed interference are modern rhymes of the same theme. Trust is fragile, debt is heavy, and gold thrives in chaos. Conclusion: a system under pressure. The world stands at a crossroads. Japan shows how quickly stability can vanish. France reveals Europe's debt fragility. The Fed faces a credibility test like never before. And gold shines as the only safe haven that investors trust. The lesson: stay diversified, stay vigilant, and prepare for volatility. September 2025 may be remembered as the month the world realized how fragile the financial system really is. If this mega breakdown helped you see through the noise, smash that like button, subscribe for more urgent analysis, and share your thoughts. Will Japan's shock resignation ripple across Asia? Can France survive its political test without triggering another euro crisis? Will Powell cut rates or cave to political pressure? And is gold truly on its way to $5,000? Your perspective matters, because tomorrow's headlines will make today's story even bigger. This is Felix. See you next time.